Want to start with, I do have the exam review out there just so you can see. You have two math problems. You have or three math problems, I guess, really. You have the bootstrapping one, which should be really straightforward, not just for this class, but it's something you should know even outside of this class. So it's a good one if you've never seen it before. The pricing problem, the most complicated one, we've walked through the process on that. You don't have to get it perfect to get a lot of credit. But you do have to know the steps pretty well. Remember, the investment income is probably the hardest part. And then the 2-year loss ratios, the um, the risk-based capital. So you see those examples. The risk-based capital is not in all the videos. And then your big essay question is credit scores. So I'll give you a little bit of um, I guess a rubric, not, I won't give you this detail of a rubric. It might be the main titles, without the sub. So I'll work on what rubric you'll see. So what's provided down here is more than you'll get, but it's the main sections talking about the need for this study, the three discriminations, which I think is really critical. What they found in phase one, that what they have found in phase two, and then what happens if credit scores are not allowed. So that's the essay. It's a fairly straightforward essay, but there's a lot to it. So it's straightforward. Most of it will come back to you if you know the outline. You'll just remember because it is pretty logical. So that is the final. If you're not sure on the essay, come draft one and come show it to me. It will be in class, closed book, other than you'll have the rubric on the exam, and the math problems will all be closed book. So instead of having class on the 29th, if you look out on Canvas, there is an exam two that will work sometime after the last class. Our exam's not until the 11th, so sometime between the last class. I forget when the last class is. It might be that next Monday after the 29th. So sometime before the exam, but after the last class, I'll do a Zoom where I'll work through this problem, give you enough time to work it after you get your papers turned in. Remember, last class we'll do the 2-minute review of your paper, which will be part of your grade. So you want to have something prepared on that. So, all right, any questions on anything? Don't do chat. I can't jump in back and forth to chat. All right, so what we want to do here, Tyrone?
Sorry, but 2-minute review, just so
Summarize your paper in 2 minutes, which is a pretty long time, but I'm going to hold you to 2 minutes. So last time we did it, like one guy went on forever and ever and ever, and we finally just had to interrupt him. So you'll have exactly 2 minutes, and you'll just be stopped. If you take a minute 30, that's fine. Um, so have something you might, if other people are doing a similar paper to yours, you might try to find those things that you think were unique that you found, so not everybody's just repeating themselves. But a good summary of what you found, and so maybe that's the objective, is what you found at a high level, and maybe some of the most interesting things you found. So, um, all right. So we're going through the accounting, and I want you to take notes here, preparing for interviews with an property and casualty insurance company. It's similar on the life side, but there's a lot of differences. We covered the balance sheet last time. If you remember the balance sheet, very straightforward. The bulk of the assets is investments, especially bonds, because this is a float business. Remember, float is the reserves. You invest the float into investments, most of which are bonds. Most of the liabilities are reserves, is float. So the balance sheet for a property and casualty company is fairly straightforward. You probably would want to know what the three reserves are for a P&C company: the loss reserves, LE reserves, and unearned premium reserves. If you know that, you know more than 95% of people interviewing for that job, mainly because this is stuff coming from the statutory side. You won't hear it as much on the GAAP side. GAAP side tends to collapse all those things into one thing. So when you get to the income statement, an income statement for an insurance company is very, very different than others, mainly because they separate the property and casualty business from the investment. The life insurance company doesn't do it quite like that. They tend to combine them. It's a little bit different business. It's a little bit, life insurance is a little more complicated, but the P&C side, they have the underwriting side all by itself, gain or loss. Then they add in essentially the earnings on the float. The the underwriting side is just like your premium pricing problem. You got the premium, you have losses, you have LAE, and you have um, expenses. Just those three items. I know they have this aggregate write-in kind of thing, but that's it. The bulk of it is the claims you pay, and then your expenses, and then your LAE. LAE again is just an expense, but it's expenses to help you pay those claims. So if you remember that, you have to know it anyway for the pricing problem. So it gives you a good sense of how the income statement looks. Then the investment income, they do separate realized gains and losses out separately for insurance companies, but most of their income on the investment side is investment, like interest income and dividends. Um, there's your investment gain. So they made $6.3 billion in underwriting, $2.7 billion in investment income. And then they have all these other net kind of things. Um, none of these are particularly important. And so there's their net income, 9.7 billion. This says dividends. I know you're thinking dividends don't belong on the income statement, but these are not dividends to stockholders. They're dividends to the policyholders. We didn't talk about participating policies. You can see Allstate, there's a zero. USAA typically pays a dividend on the auto insurance side, not on the homeowner side. It's pretty small for me. It's like $40 I get a year that they reimburse me, especially after COVID. They had a really large one that year. So you can do that if you want to say you overcharge. For life insurance, it's a much bigger number because they have what they call participating policies where they intentionally overcharge their customers and then send that money back as in the form of dividends. But insurance companies, dividends to policyholders is an expense. And then your federal income tax is down here at the bottom. And there's your net income. You notice you don't see EBIT or EBITDA. Those terms are not frequently used in insurance and banking. In fact, you'll notice on Bloomberg, a lot of times they don't even show an EBIT or EBITDA, earnings before interest and tax, depreciation, and amortization. They don't usually show that for insurance and banks. Yahoo Finance will. Then what you're doing is you're trying to get from net income to net worth, and they just show all the adjustments they make, and there's a bunch of them. We won't go through them. Here's the dividends to the stockholders. That is separate. So you can think of this as like the owner's equity statement, getting them to their ending net worth. It's very different in GAAP. GAAP accounting doesn't allow all these adjustments. It has a couple of them, but not all of these. Some of them are very specific to insurance companies. This one here, non-admitted assets, we didn't get into that, but essentially what it is, there's certain assets that GAAP accounting allow, but statutory doesn't. The biggest one is furniture and equipment. It's, you know, its desk, and they used to admit, it's kind of funny, when I started, computers were not part of non-admitted assets because their idea of computers was you buy a computer, it's going to help you for 20, 30 years. They never go obsolete. Whereas a desk or a chair is obsolete. And then they had to change that pretty quickly. Um, every state states are a little different. Texas actually admitted more things than other states, but those rules have probably been changing. It's not an inconsequential number, but if you do buy chairs, desk, the buildings count as assets, but the things inside the buildings, those are non-admitted. Computers nowadays. That's unique. Um, and there are some reinsurance related things that can be kind of interesting, but essentially the big items are not, there's not any, the biggest items, net income and then dividends. And you notice Allstate didn't pay a dividend the prior year. Then you get to the cash flow statement. The main thing I'll say about the cash flow statement is we don't use it. So don't go into an interview with an insurance company and start talking about the cash flow statement. That's important for Walmart or Apple or whoever, Nvidia, it's important. But for insurance companies, we don't use cash flow statement. Why? Well, because this cash flow they're getting, it's not cash they get to keep. Remember, it's float. They're going to have to pay a lot of it back in claims. So when a bank or an insurance company gets a cash from operations, that really is risk. They're gonna have to pay it back in the future. So it's very, very different. When Pepsi gets a cash flow, they've sold everything, they delivered a product, everything's closed, it's done. With insurance and banks, they've got to get people to pay back on the loans. I got to pay out claims. So it's not really used at all. You'll notice a big part of their cash flow is the cash for investments. That's a massive number because again, this is a float business. They got cash coming in, they got to invest it. But nothing here that would be all that particularly interesting. Look at all these write-ins, all these special things Allstate has that they're bringing in. It's theirs is a lot messier than most. They have a lot of extra stuff that other companies don't have. I don't know about how their firms manage that they have all of that. The next statement is the investment exhibit. It's not an investment exhibit. It's actually an underwriting exhibit, but it says underwriting investment. There's a separate investment, but just look at this. This is so incredible. So if you're interviewing with the insurance company, if you can get their annual report, their statutory report, you will know exactly what business they're in because it shows you their premiums, their written premiums, and their earned premiums, which are going to be fairly similar, but what business they're in. So you can see homeowners is 16 billion out of 55 billion. Auto insurance, there's two auto insurance lines. The liability and the physical damage, that's 33 billion. So we're almost up to 90% of it. 15, 40, we're up to 48 billion out of 55. You've essentially defined who Allstate is. They're homeowners auto. They're not commercial. They don't have a lot of commercial. There's really not any other line that's particularly massive in this firm. They do have a little bit of old health insurance that they had kind of left over. This is auto insurance as well. It looks like a big number, but you can very quickly look and see what business they're in. When I was comparing USA to its main competitors, there were about 11 of them. And I made sure a USA competitor, at least half of their premiums were coming from auto and homeowners. And that got me 11 competitors. So I wasn't going to pick a Chubb or Travelers that do a lot of commercial. So that's pretty cool. Not only get the premiums, but you get other things. Here you get the unearned premium by line of business. Here you get the premiums written and more detail on reinsurance, assumed and ceded that Kirby talked about. Just incredible detail. And this one you can't even see. But here they have the losses, the direct losses, reinsured, assumed, and recovered. So, I mean, it's just an amazing amount of detail. You may not get into all of that. Here you have unpaid losses. Those are your reserves by line of business, direct reinsurance. So what I wondered when I started at USA, because we had just gotten computers, so all of this was coming off of our general ledger or whatever, our mainframe. But before I started there, they didn't have computers, so they were typing all of this. Can you imagine? Have you seen TV shows from the 50s and 60s when they have the typing area? You know, it's like 50 people and they're typing. Can you imagine trying to create this thing? It's 700 and something pages long, incredible detail. And when I started, there was one statement we had that wasn't on the computer yet, and they made me as a newbie, I had to type it. And I look up and they're all in the conference room looking at me because they want to figure out how I'm going to type a piece of paper this wide and a typewriter that wide. So they're all laughing at me. But that was the only one. It was a really small life insurance subsidiary. But yeah, all of this detail now comes right out of the ledger. It just populates like that. It's pretty amazing. Talk about productivity. I mean, it's pretty amazing. Those typing cores, 40, 50 people, that's an incredible expense that computers have gotten rid of. Um, Here's another one on expenses. On expenses, they don't break that up by product, but they do give you incredible detail on their expenses. You will not get this in GAAP. GAAP is really high level. It might be sales and admin and marketing maybe. There's just not that much detail. If you go into Bloomberg and try to get details on expenses, it's pretty limited. But look at this. You have an entire page of detailed expenses that the firm pays. We talked about um, premium taxes. That should be near the end. Maybe it's on the next page. Nope. So you can find, here's the tax total. So here's premium taxes, 1.3 billion. That's almost 10% of their expenses are premium taxes. That's a big source. There's a big case that hit USAA several years ago. Carol Rylander was the state treasurer. She sued USAA and she was mad at USAA not for not paying franchise tax. And USAA is like, we're paying $1 billion in premium taxes. What do you want? And the state law said insurance companies don't pay franchise tax. So I don't know what happened with Rylander. I don't know if y'all remember her. She's a little before your time, but she was mad at USAA and USA, we're paying our taxes. We don't need to pay franchise. It is a big number that insurance companies pay, but they don't pay franchise taxes like normal corporations. They pay premium taxes. It's just a percent of premiums collected, usually 1% or 2%. They got to send that in to the state as a tax. It's probably larger than what franchise taxes would have been. And then you get the investment income. I really don't know why the word investment is in these because there's no investments. All the investments is on the investment exhibit. Here, it looks like it would be really, really valuable. The problem is the way they classify these is not all that straightforward. So it can get a little confusing. Some people classify certain bonds in certain places, but you can see where their investment income is coming from. You can look and see if there's any major changes between years. You should notice interest rates rising or falling over time. And then at the bottom, they show your realized gains, your capital gains. In a year like 2008, these numbers can be massive and they can give you great insights on what happened to their stock portfolio. But again, just you don't get this kind of detail in GAAP financials. Here I talk about non-admitted assets. These are assets that they have on GAAP, but they're not allowed to show on statutory. So the biggest item is going to be your electronic data equipment and your furnishing equipment. So it used to be Texas was the one state that allowed you to report furniture and equipment. They may still allow that. And they used to allow EDP equipment, or at least most of it. Now they don't use since you have to write that off. It's strange because they still depreciate it, so it's an expense. And then whatever's left over after depreciation, they write it off to zero and take it out of net worth. It's really bizarre that they do that. It's not an inconsequential number, but it's not massive. And then we won't go through here, but just to let you know the detail here, these are the footnotes to the financials. I don't know who types all of this. My guess is every year they just go in and copy and paste and put it back in there again. But remember, in the 50s and 60s, they were typing all of this detail, a lot of zeros, you can tell. I don't know if there's anything useful in here because I've never read them. I guess I should go in and see if there's something useful. Do you think the state regulators read this stuff? I mean, we're filing all of this detail for no reasons. They have something on swaps. We talk about that they do credit default swaps. That's pretty interesting. So that is something I might read. I probably should go through it. They do options. I'm now thinking I should read all states more carefully. They have some unusual investments that most companies don't do. So there's a notes, and you think, well, that's enough detailed information, and then you'd be wrong because after the notes, if I can get to the bottom of it, I don't know how many pages I've gone through, but probably 50 pages by now. Still going. And then when you finish the notes, you say, okay, we're done with the notes. And then they have the general interrogatories, which is questions the state asks specifically that you have to answer. I don't know if there's anything valuable in there, but it goes on for pages. I mean, look at that detail. My word. So it's pretty amazing. So I'm already on page 81, probably only about 10 of those pages for the financials I've shown you. So a good 70 pages is notes and interrogatories. I've never had to answer the interrogatories. In addition to that, each state has another packet you got to fill out. I used to have to do those. I would take 4 or 5 states a day and fill it out. They had another set of questionnaires. So it's quite the workload at the end of year, get all this done. you knew which states were easy, which states, New York's always the hardest state, which states are the most difficult to do. Some states are really, really easy. So, but all of that is in there. I'm not saying if you're interviewing with a company, you necessarily read all of this. It's probably really, really useless information, but there may be an occasional thing that's really interesting. You might kind of flip through it and just see what's going on. After that is a really important page that we talked about before, which is the 5-year historical data. This is the only place where risk-based capital comes up. I would look at your company's risk-based capital ratio, look at it over time, see if they're getting stronger, getting weaker. Remember the formula for that? You have the adjusted capital over that adjusted risk-based capital times 2. And you want a higher number is better. So that number is somewhere up here. I forget where it's loaded. But again, a lot of information, but you get 5 years of history, which is really, really nice. You can see things jump out in the company that might raise questions. You say something like that, underwriting gain, barely positive, very negative, positive, extremely positive. That's 2025. So they had a great 2025. You might look back at these years and say, was that related to a catastrophe, a losses, or was it related to their investment portfolio because of what happened in 2022 and you had a really bad investment market? I don't remember what happened in 2023 that would have made Allstate lose so much money. But yeah, you get that kind of detail. So you can look across, look for things that have changed. You always, when you go into an interview, you want to have some unique question that they showed you went into the details. So just look through. There's a risk-based capital right there. It's line 27. So you're going to take adjusted capital divided by 2 times line 29. And that's going to give you their risk-based capital. They don't actually give you the ratio in here. You have to calculate it yourself. They give you some information on their investments. They get information on different product lines and how they did. So a lot of information. Sometimes it's on a common basis, so everything adds up to 100%. So you can kind of back into what the combined ratio is. They don't put a combined ratio in here, but something kind of similar. If premiums are 100, how much are the other pieces? And this kind of shows you, yeah, look at 22 and 23, really, really high losses. I don't remember what hurricanes or earthquakes we had back then, really high losses. Their expense ratio is pretty high. I wish I could show you Geico and Progressive. Their expense ratios were more in the 18, 19% range. 24 is pretty high. Remember USAA before they restructured, they were hitting 30. So that's an interesting number to look at. Over time, you can see it's kind of bouncing around between 22 and 25. Then the loss development that we talked about, here you can look, a negative number is good, right? Because that means they're releasing reserves. They over-reserved in the past. Positive numbers means, oops, we didn't reserve enough. So you do see some fairly significant positive reserves strengthening. That's a 2-year loss development, $2.6 billion. That's a pretty high number. So again, you can look through the 5-year. I usually, when I'm looking at a company, I go straight to the 5-year to just get a sense of what products do they sell, how profitable have they been, how's their risk-based capital look, what investments are they are, and you can get and is that changing over time? You can, in one statement, get that answer pretty quickly. All right, so here's the crazy part. We'll flip through these pretty quickly, but this looks exactly like what we looked at before. Anybody notice a word on this page that's pretty important? Like, they call these the state pages. Can you get this some gap accounting? An income statement for each state by product? I mean, it's crazy. So, yeah, just all over the place. Every state, you can go look at Texas. There's Kansas, Montana, Oklahoma. I think there's still 50 states. I've seen the interviews on the street where people think there's 103 states, but there's still 50 states, I believe. So here's Texas. You're going to find Texas might look really strange. I don't know if y'all can think of why. You might look at Texas and say, wow, they don't have much business in Texas, but we know Allstate has a lot of business in Texas. Why might Texas look really, really small when Allstate has a lot of business in Texas. Any guesses on that?
It's not a lot of contention.
It's not a what?
Like the contention fees don't have a lot.
No, Texas is one of the most cat states. What do you think? Remember we talked about mold insurance? What companies do in Texas?
So
They don't sell it through this company. What do they sell it through? The county mutuals and Lloyd's, remember those? Those off the charts. So a lot of times you'll see, and I'll show you Schedule S when we look at the premiums. A lot of times you'll look down and see where Texas should be one of the biggest states and it's one of the smaller states. That's because they're going through these Lloyds and separating the business off. You'll see that on the life insurance side in the state of New York. Almost every life insurance company that does business in New York and other states, they have just a New York company by itself. In fact, remember that company I said I was typing the pages for? That was a brand new company they developed when I started. They called it Life of New York, Loney. They moved all of their life insurance business in New York into this separate company because the state of New York, their laws, I don't know how they get away with this from a Supreme Court standpoint, but their laws say you have to follow our regulations, not just for your business in our state, you have to follow our regulations for all 50 states. And every company says, no, we'll just have a New York only company. So if you see a company that looks like, man, they don't have many premiums in this state, it's probably a subsidiary that's separating it off for regulatory purposes. So there's the state of Texas. So you can't get much out of Texas here. You might be able to find that unregulated company, but who knows if they report the same stuff. Right. So what's the last state? It's not alphabetic. There's a lot of others. So you got Canada and Puerto Rico probably. They don't look like they do much in Puerto Rico. It's possible that they have a Puerto Rico only company versus not really doing business there. It doesn't look like they do anything in Canada, although there's a few little numbers there. And other alien, this doesn't mean like space aliens. They're not on other planets, but it's just other countries. And then they give you a grand total, which is going to match back to what we saw before. Then you get in these special statements that you'd probably never look at, but it's amazing again how much detail there is here. And again, I wonder if anyone anywhere actually looks at these statements. Maybe there's something we can ask Mufaro. All this detail and what is it all about? All of these special schedules just for reinsurance. Incredible detail on reinsurance. Or we should have asked Kirby this question. I wonder if Kirby, we go on to Allstate and say, wonder who they're doing business with, what kind of reinsurance do they have? They're looking at that. That might be interesting to him. For most of the rest of us, our eyes are just going to glaze over. Here's more Schedule F, more Schedule F. And I mean, can you imagine typing all, how many typos do you think there were in the 50s and 60s? There's no way they got all this correct. So yeah, I would have loved to have seen a video of insurance companies doing that. But anyway, a lot of Schedule Fs and each one has their own reason. This one's about seated, some are about assumed. So just massive, massive, massive. Still Schedule F, still Schedule F. You get how many pages of Schedule F there are, but there's quite a few. All right, so there's F. Now H is probably for most companies is empty. Think of H for health insurance. Allstate does have some health insurance. Most health insurance has moved over to the life insurance industry. It's not in. And not only that, most health insurance has moved out of life insurance and is now Humana and Blue Cross Blue Shield. So it's a United Health Group. A lot of health insurance has moved out of life insurance companies and they're now health insurance only type of companies, or even Blue Cross Blue Shield, which is not really a health insurance company. It's a different kind of animal. But they have to put that in there. USAA, this schedule would just be none. They would have never done that. A few pages. And in Schedule P, we talked about Schedule P. Remember, I love Schedule P. There's a lot more to Schedule P than what you're seeing on the exam. On the exam, I'm giving you the incurred losses, the unpaid losses, and you calculate the reserves. But there's incredible detail in here. And again, they like to do it by accident year. not by financial accounting year. That's real important to the actuaries. And then again, all this incredible detail that you get. Um, we talked about IBNR, incurred but not reported. You can see what those numbers are. Defense costs, containment. So just other detail you can't get anywhere else. Here's the salvage and subrogation. That's what they get out of cars that have been totaled or houses that have been totaled by selling off whatever's left over. You can see it's not an inconsequential number. And here's the schedule we're using, the incurred losses. This is, excuse me, this is a summary, but they do it by each product line. And again, just amazing, amazing. Here's the private passenger liability. And they go back several years, but not for every product. So we'll see. I'll flip through. And you still have to report it if you don't have any. The way we did this, it was pretty funny, is we had a transparency sticky that said none, and we just stuck it on there. We didn't type it on there or anything. We just stuck the little sticky on there. Um, Other liability, essentially going in the same order as the previous ones. There's earthquake, fire. Here's auto physical damage. Auto physical damage, they do show you all these years, but on some schedules they only show 3 years because it's such a short tail line. So you get different levels of detail, but on auto physical damage, you can see the growth in their business over time. You can look for jumps to see maybe they purchased in a company. But anyway, the Schedule P, a lot of information. I used to pull a lot of information from Schedule P looking at different companies. Um, yeah, part two, part three, parts, whatever, over and over and over again. And again, someone has to type all these. I'm assuming they had printed with everything in it except for your numbers, and you just type those in. But I don't know. It'd be interesting to see what they actually did back then. I would have hated that job. Can you imagine how boring that job would have been? Um, Actually, the detail here is a little bit more detailed than what you get in some of the other exhibits. There is, and why the actuaries break certain things out certain ways. This is Schedule P, Part 7-8, loss sensitive contracts. 7B, and then they have interrogatories for Schedule B because it's such an important one. This would probably be an interesting to read through and see what the expert is. It's not as many questions. All right, so I'm sorry, I said Schedule S, I meant Schedule T. I love Schedule T because it shows you premiums by state. As you would expect, California is the largest, but as I mentioned, Texas, look how small Texas is. If California is Florida is 300, Texas should be larger than Florida, right? But Florida is 310 billion, I think. I think zeros are omitted. Oh, that seems too much. 310 million, I guess. Texas is only 80 million. You can be sure if you see California, Florida, or Texas unusually small for an Allstate or a State Farm or something like that, you can be sure they have a subsidiary that is a Texas Lloyd or a County Mutual to hide that. There's no way Texas auto and home insurance from Allstate is half of what Virginia is. Just no way that's possible. Here they do the same thing for other products. They don't have any. And then I showed you the Schedule Y, which is extremely important. And you'll find those county mutuals in here. They're pretty, they have to be there if they're there. So you actually see the word county mutual. You actually see the word Lloyd's. I think we saw one. There's a Allstate Texas Lloyd's. There's an Allstate Texas Lloyd's. Another one, a subsidiary of Allstate Texas Lloyd is Allstate Texas Lloyd. Um, I don't see any that say County Mutual, but I'm sure you would find one if you looked. Um, so if you're a lawyer, you got a lot to do for insurance companies. Lawyers set all these things up. I was involved in at least 4 or 5 companies being set up at USA. A lot of USAs were on the real estate side when they owned the real estate company. But they had They had several. On the property casualty side, they didn't have as many as Allstate. Allstate's a lot more complicated on the property casualty side. The life insurance side, they had four companies or five companies. Um, so it just goes on and on and on. Would you read this? One thing that helps you know is, does the company have a holding company? Allstate does. You can tell because it's a Delaware company. And it doesn't say Allstate. If it's an insurance company, it's going to have the word insurance. There's a County Mutual right there. It's going to have the word insurance. So Allstate Corporation is not an insurance company. It's the holding company for all these others. And they may have other holding companies down below. How you decide to do that, your lawyers are going to look at it. What are they trying to do? They're trying to avoid regulation that they don't like. So they try to parse off companies and parse off details that they don't want to cover. So did y'all have any idea? Do you think Walmart's this complicated? They have some subsidiaries, right? But probably not anywhere close. But where would you go to get Walmart's Schedule Y? I have no earthly idea. I wouldn't know where I would go and look, and you probably don't care. You just look at consolidated. Here it's actually pretty interesting. I'm always interested in which states do they have multiple companies in. Does USA have the same there, or is Allstate doing something unusual? Why are they doing that? So, it gives you a sense of which states are really problematic, like New York, like Texas, like California, like Hawaii. You'll see these special companies that are just for those states, and they go on quite a ways. They have to file something for every single one of these companies, so that's a lot of paper going out. And for when I worked in a life insurance company, we had the life insurance, we had the annuity company. We had the Life in New York, the General Agency, and there's one other. And we had to produce financials for each one of those. And then you had the consolidated group. Yeah, it's a lot of extra work. And then what they have to do is you have the holding company system. Anytime you have dealings with a subsidiary, you have to report it to the state. So if our life insurance company pays a dividend to the property casualty company, we have to put that in this report, and you have to get it approved in advance. And so how many subsidiary transactions Allstate have? And here they are. So details of insurance company system. So at USAA, a good example would be the bank's struggling, they need cash. So we went to the state and said, okay, if our bank needs cash, we want approval for our property casualty company to buy bank CDs, to be an investor in bank CDs. So we can go out and buy $100 million of bank CDs. You can't just do that. You can't just pick a, hey, we want to buy $100 million of your CDs. You have to get it approved by the state in advance. If they approve it, then you can do it. Same thing on the bank side. If the property casualty company is having trouble, the bank can send dividends up or however they're going to get cash up to the parent company. All of that has to be approved in advance. So that means every single one of these things Allstate is doing, they had to go through the state. They get it approved once, but once you get approved once, but every single one of these things they did, some lawyer had to file that with the state. And you can see why which state you're domiciled in makes a big difference because not every state's the same. So you kind of pick your poison. USAA debated shutting down its California office because California was getting so difficult. I don't know if they ever did. They have a Sacramento office, the Colorado Springs office. They have their biggest one is probably in Arizona. What's the Arizona city? Can't think of the name of it. I used to visit the Arizona one all the time. So anyway, and then more interrogatories, more questions I've never read. And then you have overflow pages. And then you get to the investments. You notice we're only on page 286. And we've gone through everything but investments. So that means the entire rest of this, the next 420 pages, is about investments. And Allstate is about 1/3 the size of State Farm, which means State Farm, take this times 3, and that's what they're going to have. There's just going to be well over 1,000 pages. And again, someone was typing all of this. Here's the summary page. This could be interesting. I use this page quite a bit at USA. What I did when I was comparing to our 10 main competitors, I was in a department where we were comparing our investment strategy to other companies. And so we had a database, had access to all this information in statutory. I went out there and I tried to figure out exactly where all of our competitors were investing their money. Were they buying bonds? Were they buying investment grade, high yield? Were they buying stocks? Were they US stocks, non-US stocks? And for almost all of the companies, I could account for over 90% of their investments. And then if y'all know what an efficient frontier is, so your return risk, I put USAA on the efficient frontier versus competitors. And USA was fairly conservative. However, USA has huge tax advantages. And what I can show our exec counsel is that USA's investment portfolio was more conservative competitors, but we had a higher return because of our tax advantage. So State Farm had like 40% of its money in the stock market, which is crazy for an insurance company. They were really betting on the stock market, but we had a higher expected return than they did, even though we only had like 20% in the stock market. So,
What was the USA's tax advantage? Like what's unique about?
yeah, they don't take as much advantage of it now, but they're reciprocal. And when you're reciprocal, your net worth belongs to the policyholders, but you can actually assign it to them. So if you make $1 billion, you can say, well, put that on net worth, but we're going to assign that to our policyholders. That is tax deductible. You didn't spend any money, you didn't send any money out. You just say, our net worth, it's 20 billion. We're going to assign another 500 million of that to our policyholders. And that's tax deductible. And so I think I might have talked a little bit about this on the stock side, but on the stock side, if your stocks pay $10 million in dividends, that's taxable. But if you assign that to the subscriber savings, it's tax deductible. But then that's for the company. So you make $10 million, but you assign it. That's at the reciprocal side. So you have zero tax. But then you file your corporate tax return. And corporate tax return, you get what's called the dividends received deduction. You take those dividends and the IRS reimburses you 15%. So our return on stocks after tax was higher than our return before tax. There's not any other company out there. So essentially all the investment income at USAA is tax-free, plus they get an additional tax benefit. The problem they were having, which is maybe an issue today, is they're worried if they kept assigning too much to SSA, those longer term members that might have a $10,000, $20,000 balance, they might say, no, I'm driving anymore. I want my money out. And so the rating agency started worrying that there was going to be a run on USAA, that especially those big, big, big balances that they're going to say, just, if you're not driving much, you got $30,000 sitting there. So, I'll just cancel my USA insurance. I can go buy insurance from Allstate if I need it. Give me my 30,000. So they haven't done it as much, but while I was there, they were still allocating most of their net income. And so I remember talking to my boss, says, yeah, I'm absolutely sure it's correct. Their after-tax return is higher. And so when you compare to Allstate, where all of that investment income is taxable, it's a huge, huge benefit. There's a guy named Steve Darcy. I don't know if he's still around. He's a very famous actuary. And he came to USA talking about how you value an insurance company. He's talking about public companies. And so I said, well, let's take that equation, let's apply it to USAA. And the two of us took the equation and everything canceled out except for the T, taxes. He says, yeah, USA is just a tax machine. That's how you maximize the value USA. You just maximize the taxes. It was but it was pretty funny going through the entire equation. We kept canceling things out because it's owned by its customers. So your customers are both your customers and your owners. So if you maximize the value of the firm, you're harming the customers. So what do? Well, you overcharge them and pay them big dividends. That's tax, you maximize the tax benefit, and that's how you do it. So it's a strange, strange, strange company. I don't know how that would work at State Farm. Um, and that's the debate we had at USA. Do you maximize the value to the customer or maximize the value to the owner when they're the same people? And we said, well, let's maximize it to both by taking advantage of the tax as much as possible. Strange company, right? There's not much out there that's like that. Now, why is this part of the schedule? It's called Schedule D. Schedule D is massive. You start off, you look for this page. It used to have a big X on it. It doesn't anymore. The summary, they say by country. That's false because the only countries they have are US, Canada, and other. So there's not a lot of countries here.
said, this is something you said previously, you said, they had a 40% allocation to stocks. Did y'all have more of an allocation to bonds or?
USA was weird in having a substantial allocation to real estate. We were the only ones in the industry that had a high allocation. We had 10% in real estate. Um, on the stock side, I think we limited real estate plus stocks to 50% of our net worth, which is a huge number. Um, so we had a stock allocation. Our stock allocation was pretty normal for the industry. The industry does buy a lot of stocks, whereas the life insurance doesn't buy any. But having 10% in real estate, most people think real estate, that's just too illiquid for a property and casualty company. USAA had worked out really well. They had, well, it didn't when they started. It was horrible when they started. Give you some inside information on the company. They were building horrible things like Fiesta, Texas. Um, but when Ed came along, I won't say his last name, when he came along, really great background in real estate. He revamped that whole company. And they're the ones that did all the lock and terror, which they're doing really well there. They do a lot of build to suits. USAA real estate really saved them during the 2008 crisis and other places where the real estate was doing extremely well when the stock side wasn't doing well. Um, USA also doesn't have as much municipal bonds because of that tax situation. When you don't really pay tax, you don't need municipal bonds. So Allstate, State Farm, they'll have a really huge. I've seen Allstate with over 50% of his assets investments in municipal bonds, which to me is scarier than USA having 10% in real estate because municipal bonds are not that liquid compared to other bonds. But you'll see some of those. That's the one thing I discovered in looking at these 11 companies. There really isn't one industry strategy on the investments. And that's the reason we just started this department is to try to figure out what should the strategy be for a property and casualty company because it had never been studied. And that's the reason I went around the country essentially reporting on investment strategy for P&C companies because no one had really done it before. I got a lot of exposure to the rating agencies because they'd never seen this before. What did y'all discover? What did you find? No one had sat down and compared all the different companies and tried to figure out the advantages before and after tax. They're really quite different. So if you work for one of these companies on the investment side, there's a lot of value added you can do. There's a lot of questions you can ask. There's one firm I looked at that one of its board members had way too much power and the investments made no sense at all. He was doing some really bad stuff. And this is a pretty sizable. Their CFO called me and I was talking to him. I said, you got to get that guy off the board because you shouldn't be buying. He was buying investments to benefit himself. I'm not talking about $1 million company. I'm talking about like multi-billion-dollar companies. So you can add tremendous value on the property and casualty side, on the investment side. On the life insurance side, probably not because the actuaries drive everything on that side. You're just trying to find really good bonds, but you're not strategy wise. There is no strategy side on the P&C on the life side because the actuary is going to drive all of that. What quality bond you buy, what duration, what convexity. But on the property casualty side, there's tremendous value you can do. I felt really good that year. We went through all of that. We made some pretty radical changes. So about $20 billion of their assets and reinvested it. I mean, that one year we made radical changes to their portfolio. Just great opportunities there. This is a summary page. It can kind of help you again, the definitions, like they don't break up governments from municipals. It'd be really nice if they did. When I did the project, I actually brought in every single security by CUSIP. So I could tell if it's municipals or governments. It was it was back before Excel could hold a million lines. So I had like 13 spreadsheets for State Farm, and I had to summarize them all. And I mean, it was tough. It just it was just pages and pages and pages. But you can bring in the QSIPs and look them up using a bond analytical tool. So this doesn't really help you. You really have to get into all this detail that comes after this. Schedule D is really helpful because if you look at the total way down here somewhere, man, look at all these pages. So the total, these NAIC ratings equate very closely to investment grade to investment rating, credit ratings. So NAIC 1 is probably AAA and AA, and then when you get down in 4, 5, and 6, you're getting into the below investment grade. And they equate really closely. It's not like the NAIC has their own rating agency. They essentially use S&P and Moody's. So here's a place you can go. Once you go through all of that detail, right here's a place you can go and see how much they're holding below investment grade bonds. Probably more important on the life insurance side than the property casualty side, but you want to see if a firm has more than 10% of their net worth. Were you in my life insurance class? Remember we talked about on that ALM thing, should you buy the triple B bond or the high yield? There are life insurance companies that buy a lot of high yields. You don't see that so much on the property casualty side. They're not quite so aggressive. You can see with State Farm. So you're looking for the total. There's a total. There's a total. So you can see for them, the below investment grade is pretty small percentage of their bonds. It's like 3.4%, where a life insurance company might be 10, 20, 30%.
So it's 5, 6 high yield.
I think I'm pretty sure it's 4, 5, and 6 because triple B is going to be pretty substantial. So it looks like that's probably single A and triple B. I don't know. I'm not sure exactly where the break happens. My recollection is it's 4, 5, and 6 is what I was pulling for the below investment grade. Um, they do hold a lot of municipals that tend to be more highly graded. Um, but yeah, I mean it's interesting. You can look at it over time as well and see how they're doing. This is all available electronically now, so you can actually pull all of that in a computer. You don't have to go through and type it all out, so it's much easier now. And that database. It's a database that comes from Standard and Poor's now, and it's very easy to use. You can bring in a lot of data. Now I was bringing in the actual bond by bond by bond. That did come in, but we didn't have a million lines in Excel, so I could bring in maybe, I don't know, 5,000 bonds at a time or something. I'd have to just stack them up and sort them out. And it was, I remember doing that. But oh, it's so valuable. When I showed it to the exec council, I don't think any of our competitors did this because it was pretty rough to get it all together. But they could see exactly how we were investing versus all of our peers. That's a pretty powerful piece of information. Um, Yeah, they have just some detail. Schedule DP is really important for Allstate. That's where you list your really unusual investments, and Allstate does a lot of this, things like private equity, real estate. Allstate does a lot of private equity. I don't know if you can see some of these unusual ones. Oh, they do swaps. There's their credit default swaps. Um, yeah, they do a lot of derivatives. But anyway, you can get all of that out of the Schedule D DB and see what they're actually doing. Um, and then you get to the Schedule D. I forget what Schedule E is, but not important. All right, so Schedule A, I think it's the real estate that they own, including their home office. Now, USA's this schedule is funny. I did an experiment with all of our 10 competitors. I want to see what percentage of their investments I could come up with, and most of them were really close to 100%. So then I said, let me pretend like I'm doing this for USAA and I don't have inside information. For USAA, I could only get about 80% of their assets. So USAA was hiding more stuff than the others because all of USA's real estate was hidden down below in a holding company. So you couldn't actually tell what they had. Um, Whereas these other companies, they did actually put their real estate on Schedule A. USAA did not put its real estate on Schedule A, but they have to list every property that they own. They don't own that much real estate. Schedule B is mortgage loans. There's not going to be much of that. You'll see a lot more of that on the life insurance side. I don't know why the letters are going out of order. Yeah, they show a lot of mortgage loans, but they don't. If you combine them all together, it's not that much. Um, More Schedule B stuff. I want to get to Schedule D because I think you're going to find it's amazing. Man, there's a lot of Schedule B. BA is other long-term invested assets. Man, I want to get to Schedule D. Man, Schedule D is the biggest part of this. There we go. All right, Schedule D. So this is absolutely amazing. Again, I have to wonder if they actually typed all this in the 50s and 60s. I mean, I can't even imagine. You have to list every single bond you own with the CUSIP. Y'all know what a CUSIP is? Anybody? Have you ever heard of that before? So you know what a ticker is for a stock? So bonds don't have tickers, they have CUSIPs. So every bond has its own identifier. Here's a CUSIP. You can see it's not a short number. So again, I can't imagine typers are typing all that. Typing it from what? Where does it exist? I don't. So this is must have gotten added at some point. It just doesn't make sense to me. Um, but you have every bond, you have its cost, its par value. Fair value is not its market value. It's the adjusted book value. Um, all this other stuff. You have the effective rate. Just all this detail you got to put in there. The date acquired, when is it mature? I use the maturity dates to try to figure it back into the duration of these different, are they longer duration, shorter duration in USAA? But every single bond that they have to put on a schedule. And this is part one. This is the bonds they own. So it lists every bond that they own and all of that detail. So you think about an Allstate, which is, they may not, even though they're 3 times larger, they probably don't have 3 times as many bonds, but they're going to have 3 times as much. So they're going to have more bonds definitely in their total amount. So there's part one. Part one's going to go on forever. I don't know how many pages I'm doing here. About 10 pages of swipe. Oh, part one, section two is asset-backed securities owned. Part two is stocks owned. So every stock, this is how I got their large cap, small cap, and non-US stocks and emerging market stocks. I brought in every stock that they owned and I matched it up against the S&P 500 and I made that large cap. Everything else I assumed was small cap, unless it was not in the United States. It took me some time because I did that with 10 companies. So, and I did some good overtime back then. Off of Bloomberg, I had worked with Bloomberg to figure out what was in the S&P, and I put it all into Excel and did matching up. I mean, it was you had to be good at Excel back there. There's part two, part three. All right, so part three is all those bonds again, but just the ones they acquired during the year. So they're listing them all again, but just the ones they acquired during the year. So you have that at a detail level, which is kind of bizarre. And you can guess what part four is. We can get to it. Part four are the ones that they sold during the year, disposed of. And those are all listed by CUSIP all the way in there. I'm beginning to think there's no way they typed these in the 50s and 60s. They must have added this. It just seems too insane. Of course, they didn't have asset-backed securities in the 50s and 60s, so they at least lost that one schedule. Part four, they actually have a schedule that is bonds that they acquired and disposed of during the year. So like a commercial paper, that short-term stuff you buy. So I don't know why they need all that detail. I doubt anyone's looking at that. But anyway, all of that. So there's part four. Part five. So here's the acquired and disposed of during the year. And he lists all of that. You might think that may not be much, but these firms do buy a lot of commercial paper. Disposed of doesn't mean they sold it. It just means it matured, came off the portfolio. Look at that, man. Isn't it amazing how much detail there is on stuff they bought and sold this year? It's a lot of detail. And again, it goes on for pages. So I don't know how many pages that one. Remember we started about 220 something, and now I'm on 658. So 400 pages of this is just details on the investments. You're not going to get that in their annual report. You're not going to get that out of GAAP. Some of it's really useful. A lot of it's just noise and not very useful at all. Why did they do all of that? It's at USA, when I started, they had what they called the investment bridge. All of this was on their mainframe, and they just that year gotten the investment bridge. I should go talk to the guy who did that, Brent. He's a good friend of mine. or used to know, I haven't seen him in years, but he's the one that implemented the bridge. Is what was it like before the bridge? Because with the bridge, all of this data came from our mainframe and went right into the financials for the states. And they were, can you imagine? They were really excited to have that bridge because now everything just feeds over. There were some checks and ties you had to do to make sure everything came over correctly. But yeah, that was going on in 1987, 88, well before you guys were born or even been thought about. So yeah, a lot of automation in the mid 80s when I came out of college, fortunately for me. Um, I remember one of the actuaries got an AT&T computer, and we were all so excited because it was so powerful. And I can't imagine today if you saw that thing. I don't think it could do anything today. It would have been so worthless. But we're all lined up around it. Wow, this is so cool. Can you imagine? Oh, he's got so much power. We were all so impressed with this actuary. Today, you wouldn't use that for a doorstop. It'd be completely useless. Um, they do have some other stuff on subsidiaries, but related back to Schedules D, where you're saying, okay, here's my Schedule D, but related to these type of things, so there's just more detail on stuff they've kind of already shown. But Allstate is very unique in doing a lot of derivatives. We did derivatives at USA. We had our stock portfolio hedged. So I had some put and call options going on, but nothing like Allstate. I did swaps, but I did the swaps in the pension plan. Allstate really does quite a few of them. It'd be interesting to go back and see what it is Allstate's up to. So why is that important? Well, if you want to be a investor, you want to be on the portfolio side for an insurance company, Allstate might be a really good company to work for you because they're going to have some sophisticated people doing some interesting things. And just think about going into the interview, they ask the question, why do you want to work for Allstate? You now have an answer. Your schedule, DB is off the charts. You guys are far more, they're going to love it. You guys are so much more sophisticated. I want to work here just to learn what you guys are doing because you obviously have some of the most sophisticated, you can flatter them, flatter them, flatter them. But Allstate is doing some stuff. Maybe they don't know what they're doing and are completely messing up, but you can go in telling them you're really impressed. Others firms, you look at their schedule DB and it's going to go on for a page or two, maybe. USA's most of it. USA did do some private equity. But it wasn't much. It was a few $100 million. It was maybe one or two pages. So Allstate is really, really unique on this. I don't think State Farm would have nearly that much. More Schedule DB, more Schedule DB. I mean, just if you want to look at a transaction, pending fire year note, Mars effective attached security, cash security, probably related to some derivative that they're doing. So yeah, who knows if those are credit default swaps or what exactly they're doing. More Schedule DB. Yeah, it's crazy, crazy detail. We're getting close to the end though. Um, securities lending. Do y'all know what securities lending is? Anybody? Y'all have heard of Al Gore? Al Gore was on the board of directors of a securities lending firm. Doubt they hired him for his expertise. I think they just wanted his name. So
Isn't it like when you buy stocks and then you hold it in somebody else?
yeah, so securities lending there's an entire industry that coordinates when you short a security. Yeah. So I don't know if y'all know exactly how it works. You probably should as a finance major.
It's like someone owns the security and then when you short it, they give it to you for that period, but then eventually you essentially you have to give it back to them. So that's where like you have that time frame to essentially make money before you never.
Right. So you want to short, let's say a stock, all right, from B. All right. So B owns the stock. So you sell the stock. You don't own it. B owns it. Now, does B care? They don't even know you're doing this because that securities lending industry, they're doing all of that for you. All right. And B has your cash. So this part, I learned this. I was like amazed. B pays you interest on your cash. Did y'all know that? So when you short a security, you give cash, they give you securities. The person you bought the security firm is going to pay you interest. All right. So you have the security and make a return over the cash, you hope. So, well, I didn't say that right. You have the security and its returns. So you're making, so if you short Apple stock, you're getting paid interest for what you paid for Apple stock, plus you get all the returns Apple is. So what's in it for B? B pays you, say, 2% interest and invest your cash at 3% interest. And so the reason people do securities lending is you make a spread. And that's what that securities lending industry does. We dealt with, I forget the firm we dealt with, but Al Gore went on their board, so I could probably figure it out. I doubt he's on the board anymore. I thought it was pretty cool, though. I never got a chance to talk to him, though. He was too busy doing global warming probably by that point. It was after he was vice president. So if you want to understand securities lending, the reason the firm that lends out securities does that is they want to get your cash. They got to pay you interest for your cash, but they want your cash and they want to make a spread. So what is the risk here? The risk is what B buys defaults. So what they buy to make 3%, if that defaults, they're in trouble because they still got to pay you the 2%. So you just have investment risk, and that has happened. There have been some security lending deals that has happened. So USAA, one of USAA's so USAA, the property casualty company, because they're worried about liquidity, right? They might need $1 billion, $2 billion in cash really fast. So they had a contract with this security lending firm to help USA get its securities lent out. And USA wouldn't do it all the time. Mutual funds do it all the time because you know, like for a small cap and mutual fund, securities lending might add 0.2, 0.3% to their return. I mean, it's pretty material. Large cap, it might add 5, 10 basis points to the return. If you watch Vanguard mutual funds, their S&P 500 index funds, they'll actually beat the S&P 500 because of what they're making off securities lending. So mutual funds do it all the time. In fact, in 2008, we were getting complaint letters because we were shorting our bank stocks, and people were like, don't short it, the bank stocks are going down. And we're like, we have no choice. We got to get the maximum return we can. So USA, not the mutual fund side, but the parent company, they use it for liquidity source. What they said is, hey, if we have a major hurricane, we suddenly need $1 billion, rather than selling those securities on the market, we'll lend them out. We'll get the cash. We'll have to pay interest on that cash. So we're going to lose that interest, but it's a cheaper way to borrow money than actually borrowing money. It's better than selling the securities because we'll eventually get cash as we do business. So for USA, they would do it. They would test it every once in a while. And the best securities to lend, the easiest, are treasuries and mortgage backs. The best are small cap stocks. Those stocks that are illiquid, they don't trade very much. Securities lending on those, you can get a pretty good spread on those. Regular stocks, yeah, you can lend those out. You can get some cash on that. But yeah, securities lending is pretty important to the industry, pretty important to the mutual fund industry as well. You can see Allstate does a lot of it. USA did not. USA really only did it to test it, and then if they had a hurricane where they need cash. So I think we're getting really close to the end. Oh, they have some information on short-term investments, which is kind of just Schedule D again, but just for cash and commercial paper. And then they have an index at the end. And then some overflow. So did you have any idea this existed? It's pretty crazy, isn't it? That all this information is out there. So if you work for an insurance company and you have a big project, ask them if they have access to this database. It's sold by Standard & Poor's. It's called SNL. At USA has it. You just got to figure out whom to ask, and go find that person. My best friend used to be owner of it, but he's now Victory Capital. Um, I would give this database to our interns and just give them a project. Go figure out what this firm is doing, and I show them how to do it. We had one guy, Jose, really good intern. Oh my word, he figured things out so fast, and he was ahead of me. It's like, no, I think I can do it like this. So the database is really easy to use. He didn't have a really strong insurance background, but he figured it out really fast. So if you start a new company and you have an interesting question, ask them for this database. And if they don't have it, you may ask them to purchase it because it's probably not that expensive. It's not as expensive as Bloomberg would be, like 3,000 bucks a month. I think it would be worth it, and you could answer questions. You could be the hero of the company. You can answer questions no one else could answer. I was doing all kinds of pro bono work for regulators and credit rating agencies because we had this database, and my boss was like lending me out because he wanted to get those bonus points with rating agencies and regulators. And so all I had to do was come in on Saturdays and Sundays and work 20 hours all weekend, but it was really valuable stuff. So. All right, that's it for accounting. We will talk about regulation on Wednesday. It sounds boring, but it's actually more interesting than it is. Then on Monday, we have the guest speaker. Then no class on Wednesday because we're going to make that a review session after. And then we have your paper. I think I hit everything, right? So you know what we've got going. So, all right, I'll stop it there. Hopefully your papers are going well. A few loose ends to cover at the end that are actually pretty critical. So we talked about the analysis you can do, the accounting. This is the database, the SNL, not Saturday Night Live, but it's owned by S&P. Standard & Poor's is a publicly traded company and a really interesting trade. Both S&P and Moody's are traded companies, and I think you talk about economic moats, they have huge advantages in their databases, and the fact that they bought this database is pretty interesting. So if you work for a firm on the insurance side and banking, SNL does both banks and insurance. And you might ask if they have access to this database. If it's a large insurer, there's a good chance they probably are paying for the subscription because it gives you access, all that detail we saw last class. You have access all that in a query that's really easy to use. We talked about risk-based capital, not to get in too much detail, but risk-based capital was developed during my tenure at USAA. It was probably the best thing the regulators did. We'll talk about this a little bit later, but insurance companies are regulated by the states. And during the banking crisis in the 90s, a few legislators in Congress said, what about the insurance industry? If banks are going under, what are we worried about the insurance companies? And so the federal government said, we better regulate insurance companies. And so the states stepped in with this risk-based capital, got it approved very quickly. It got all the states to approve it, and essentially kind of went to battle against the federal government. They won the battle, not so much because of risk-based capital. Really, the federal government just lost interest and forgot about it. But it looked like it was going to move. USA was fighting pretty hard. It was interesting. We'll talk about it. But USA was kind of on both sides of the argument. Do you want the federal government? Do you want the states? But risk-based capital was a really big step up on regulating how much net worth a company, insurance company had. You've already seen what was there before, which is that surplus ratio, that 3-to-1 ratio that you're using on the math problem. So this is a step up, a little more sophistication. Banks have this same type of thing. If you're interviewing with the bank, go and type tier 1 capital. You might even type the word Basel. If you're going to interview with the bank, especially on the corporate side, Copilot gives you a pretty good description. You probably want to know what your bank's tier 1 capital is. Investopedia has a discussion. Wikipedia has a discussion. Well, I like Wikipedia. The Basel III Accords. Essentially, these are risk-based capital, but for banks. It's a little better known on the banking side because the bank regulators are a little bit more public in what they do, but you can get a pretty good discussion in there. What's a good number? I wouldn't go into a bank interview and not know what a good capital ratio is. Is 8% good? Is 10% good? Frost usually like 11%. Is that a good number? And Frost Bank might even advertise it. Banks ranked by tier one. JP Morgan, Bank of America, but it doesn't show their tier one. It just shows their amount of capital. But it's a number that's easy to get from Bloomberg, as you can bring in. Risk-based capital is a little more challenging. I don't think Bloomberg has risk-based capital. There's not a place you can go get it other than that SNL database where you can get it. And you remember where you're going to get it because you're going to do an exam. You get the adjusted capital divided by that number times two because you can't get the actual risk-based capital. You only get 50% of it. So it replaces the old 3-to-1 surplus ratio, something more sophisticated. There are other capital ratios out there, like the rating agencies have their own models that are similar. And both the P&C and Life are using a very similar formula where there's four pieces. There's C1, C2, C3, and C4. C1 is asset risk. That's the risk that an asset will lose a lot of value since property casualty companies own a lot of stocks. That's a big part of their C1 risk. It also worries about bonds going default. C2 risk is a big one for property casualty insurance companies. That's the insurance risk, the risk of catastrophes or high claims. C3 really only applies to life insurers. That's that interest rate risk or risk that you don't match your assets to liability very well. And then C4 is just everything else. It's a catch-all risk. They didn't really know what to do with C4 risk. The reason they put it in there is they went back historically and say, what's the number one reason property and casualty companies go insolvent? It wasn't catastrophes. It wasn't stock market crashes. It was bad management. It was management doing stuff they shouldn't be doing. And so that's why they add the business risk at the end, but they don't really know how to measure it. So it's kind of a strange one. I won't get into this, but the way they put it together is they add C1 and C3 risk together and then square it. They add that to the square of C2 risk. They take the square root of all of that, and then they add C4 risk on the end. Essentially, what they're saying is the correlation between C1 and C3 risk, asset risk, and interest rate risk is a 1. The correlation between C1 and C3 versus C2 is 0. That's why they're adding them separately. They take the square root of all of that and then add C4. They're saying C4 risk is 1 correlation of 1 to all the other risk. It's a really simple way. I actually like this formula if you need to figure out how to put risks together. If they're uncorrelated, square and then add and take the square root. If they're highly correlated, add them together, then square and take the square root, or just add them. If the correlation is 1, you just take the weighted average of the different risks. So it's an interesting formula. When I saw this, I was like, what are they doing like that? And the head of my department, PhD in economics, he goes, oh, I see exactly what they're doing. They're thinking a correlation of 0 or a correlation of 1. It's a really simple way to put risks together. We've already done that. We went through the financials in pretty good detail. Talked about the state pages. So investing, real quickly, we did investing earlier when we talked through the financials. Property and casualty companies, they're heavy in bonds, but not as heavy as life insurers. So P&C company might have 70, 80% in bonds. A life insurance company might be practically 100% of their investments are in bonds. Property and casualty companies do buy other things like stocks. They have a lot of in stocks. P&C companies, they have much more net worth. They're better capitalized than life insurers. That's one reason they can afford to have the stock side. You want assets to help match your liabilities. With the P&C company, their liabilities are pretty uncorrelated to the investment market. Unlike the life insurance company, it's all about interest rate risk. Property and casualty companies, it's a little bit more difficult to get. So there's really no place to go. So we talked about tips, inflation-linked bonds, and how you might be able to use a tip in treasuries and corporates to create like an inflation-linked corporate bond. Inflation is important to property casualty companies, but it's not general inflation. TIPS cover general inflation. Property casualty companies are exposed to the cost of cars, parts, hospital. They're somewhat concentrated on what inflation. They're actually sensitive to housing pricing, house prices, construction costs, those kind of things. So CPI might not be the best coverage for them. Um, we've already done the bootstrapping, so we won't cover that, but you could figure out a way to try to buy. I don't think insurance companies buy much in tips, so that's why I said it would be good to buy tips, short nominal treasuries, and buy corporates to try to get that inflation protection, but I doubt anybody does that. So property casualties, they mainly buy bonds, and within bonds, they are a really huge investor in municipal bonds. This is a concern for municipal bond holders. If we have a major catastrophe, a major earthquake, major hurricane, and you own municipal bonds, you may talk to your uncles or grandparents if they have a bunch invested in municipal bonds. They may notice municipal bonds drop 5–10% if we have a major hurricane because property casualty company is going to be selling a bunch of those things. So there's a little bit of issue there. They do buy publicly traded stocks. They're very volatile, but they're also extremely liquid. It's very easy to sell stocks very quickly. And there's some that think that stocks are an inflation hedge. That's not, you can't make a strong argument because in 2022 we had high inflation and stocks fell 20%. It doesn't sound like a very good hedge to me. Some people say, well, over the long term, because companies can raise their prices and those kind of things. But P&C companies, that's kind of the argument they make. Let's buy stocks because we can hedge some of the inflation risk. Life insurers do not buy any stocks. So it's pretty straightforward. It's mortgage-backed securities, other corporate bonds, and stocks, except for Allstate does all those unique kind of things, and USAA that does a lot of real estate. All right, let's talk regulation. It sounds boring, but it's actually pretty interesting, and you need to know it. When you work for a regulated entity, like a bank, like an insurance company, like a utility, before you go into the interview, look up the regulation of those entities, understand it, because it's pretty critical to understanding how the firm operates, its pricing. So I'm going to skip this. If we have time, we'll come back to that. So let's look at the history of regulation. It's pretty straightforward. If you know this, you're in good shape. So the US, coming out of the Civil War, we're starting to see insurance companies growing on the property casualty side, some probably on the life insurance side as well. Not any auto insurance, but maybe they had horse and buggy insurance, who knows? But in 1851, companies are selling insurance in multiple states, and states start regulating and telling companies what they can do. The primary focus there was on are your prices accurate? I don't know what actuaries did in 1851 without calculators. Like maybe they had slide rules. When was the slide rule invented? Always been curious. Have any of y'all ever used a slide rule? Like I know there was like in my high school there was a slide rule club. Oh, that can't be true. 2011? I don't think so. I don't know when. It's not. But we had a slide where we actually had math students using the slide rules. So I've never used one. I wouldn't know how to do one. So I don't know how actuaries actually did pricing back then. They had statistics, they had probably some data, but it was probably pretty tough. And that's what state regulators are working on is, are you charging adequate prices so you don't go insolvent? There was some treatment of policyholders back then, but not much. And so insurance companies, they looked at the US Constitution and they say, why are the states regulating us? The US Constitution is quite clear. And we'll get into that. In 1869, this guy, Paul, he was from New York and he was selling insurance in Virginia. And Virginia said, you can't sell insurance in our state without a license. And Paul said, drop dead. I can sell insurance anywhere I want to. You have no authority over me. What was his argument? The Commerce Clause. So if you're going to interview with an insurance company, you better understand the Commerce Clause in the US Constitution. So I like to read the Federalist Papers maybe once a decade. They're pretty boring, but except for a few of them are really good. But in the Federalist Papers, you probably studied that in high school. Was it Hamilton, Madison, and somebody else? wrote this to try to convince in 1789 for us to have this constitution. And the states were like, no, we want our rights. We don't need the federal government. And so they're arguing for this. And in the Federalist Papers, they argued the federal government should only have three powers: treaties, wars, and regulate commerce when it involves citizens of more than one state. Interstate commerce. That's the Commerce Clause. They said, and they were not arguing that this is all we should be able to do. They were trying to convince people it should be really, really limited, but we should be able to at least do these. Obviously, the federal government does a whole lot more than that now, so they've somewhat gone beyond the initial framers of the Constitution. They said that's all we should be able to do. Do treaties, wars with other countries, and regulate commerce. So this is the most important one from our standpoint. Anytime there's a business that crosses state lines, the federal government's going to manage that. Why? Well, because if Paul comes to Virginia, Virginia's going to say, well, we like our people better than people from New York, so we're going to give our people preference. And the Supreme Court or the Constitution says, no, that's not fair. People should go across state lines, do business without being mistreated just because they're from another state. So what did the federal government decide? The federal government decided, strangely, that insurance is not commerce. They said banking's commerce, but insurance is not. You can go back and read the case. I haven't read it in a while, but it's interesting. I gave you a link to the case that may or may not still work. Who knows? Forgive me if anything else comes up. It is an interesting read. It's much shorter than later Supreme Court cases. But essentially, if you read through it, part of it, you got to think about the time. 1869, the Civil War has ended. The Supreme Court is somewhat skewed towards states' rights. So that's why Lincoln had some trouble with the Supreme Court. The Supreme Court was more pro-states' rights versus Lincoln is more federalist. And so the Supreme Court was somewhat siding on the side of states. And they made some arguments that insurance wasn't commerce that really don't make sense to us today. Things like there's no physical product, well, there's no physical product to banking either. So they made some arguments that were a little bit strange. But that's what they decided. Insurance is not commerce, therefore the states can regulate it. And that was it, 1869. Well, a few years later, just 2 years later, insurance companies go, well, now we've got, and I don't know how many states there were in 1871. I can't even guess. Maybe there's 25. Who knows? And insurance companies in the United States are saying, well, now we got 25 regulators. How are we going to possibly compete if we have 29 regulators? It's going to increase our costs. We got to deal with each regulator separately. It's going to make us very expensive to deal with. And so they went to the states and said, we gotta figure this out. We can't be dealing with all these different states. And so all the states got together, the regulators got together, and they created something that still exists today that has a website that you can use. A really, really good website. I don't know if any of y'all are using this website for your papers, but you can. It does have those topics. I don't know how good their search is, but they do have search. They even have their committees. You can look at the committees and see if one of the committees would be dealing with what you're dealing with. They probably have a catastrophe bond committee. They probably have a global warming committee. They probably have all of these things. So the NAIC, National Association of Insurance Commissioners, all the regulators, key regulators of each state got together and they promoted uniformity between the states. So if you're interviewing with an insurance company, have some knowledge of what NAIC is. It's really, really critical. Kind of like if you interview for the bank, you want to know who the federal regulators are, what the SEC does, what the Commerce Department does, who's responsible for states and state and federal charters. But for insurance companies, life insurance, property casualty insurance companies, they're regulated by the states, but the states have this organization where they promote uniformity. They don't have any legislative powers. They can't regulate anything. They're simply a group getting together like a trade organization that is influencing what each state does. So they can create model laws, but they can't pass them once they create a model law, like the risk-based capital law, and then each state has to approve it. The risk-based capital model law was their best success ever. They wrote it, got it drafted pretty fast, and got all 50 states to approve it really, really fast. It was a pretty amazing accomplishment. They're not always that successful. The states still have control, but they do things that do make it much easier for insurance companies. And we just saw one of them when we looked through all states' financial statements. Those accounting statements, the states all got together and they figured out what format that was. So you file that annual statement that we looked at for all states, you file that in all 50 states. The way we did it, we published ours, we took it to a printer, they published them. And again, we had these little stickies and we just put each state name on each one of them and just mailed them out. And it was the exact same book for each one. Now we did our accounting based on Texas rules. So it's possible Texas rules are a little different than Florida or California, but all the other states accepted our financial statements based on Texas rules and just went to each state. They've tried this accreditation thing. That's been really debatable, that really debated, that you have to get accredited by the NEIC. And if you're not, all the other states are going to go in and do an examination of your companies. If you are accredited, then when your state examines your company, that's accepted by the other states. So essentially, you're trying to threaten companies or states, get accredited, pass all our model laws. If you do, your companies won't get audited quite so much. People didn't like that, especially in New York, didn't like that. So I'm not sure how far they've gotten with that. When I was at USAA, I had to deal with state auditors. It's not a high paying job. It's a pretty low stress job. So if you want low stress, one of the guys at USAA quit USAA and became the state auditors because he wanted fewer hours and less stress. So it was a little bit nicer life. They would come in the mornings. They'd spent the first 2 hours reading the newspaper. We always gave them the best places. You know, USA has nice cafeterias and break rooms, so it's kind of a nice place to be. They loved USAA, so they would take quite a bit of time at USAA. There was usually one or two other states there, so they somewhat rotated, where every 10 years you'd see a different. So Delaware one year, Connecticut next year, and that was kind of interesting. The auditor from Connecticut, no, from Delaware, she did not like me at all. She kept saying these two numbers should tie, and I'm like, no, they shouldn't tie. And she kept going on and I was like, I don't care. But anyway, I don't. She kept coming after me. That's what it is. So it is a job. Some of the auditors we had were right out of college, and so they're pretty green. They were still not real sure how insurance, and I was pretty green. I was in my second year, so it was a bunch of people who didn't know anything talking to each other. Um, but it is a career. I don't know if I'd highly recommend it as a career, at least not long term, because you might start off at the same pay as you would if you started at a USAA, but 10 years later, you're probably going to be making 2 to 3 times more at USAA than you would at the state. It's just the growth. When I was at USAA, my first 10 years, it was rare for my pay raise to be less than 10%. You know, and 18, 19, 20% was pretty common because you go from a grade 20 to a 22 to 24, and those were big. So your pay increases pretty rapidly. You don't see that at the state level. The state level, it's a 3, 4% raise. So, but if you do it, you get some experience and move. I wouldn't say they're more than a couple of years. It is a profession, but the NAIC set this up. Still in place. I was in a job for 7 years where we dealt very closely with the NAIC. It was about a fourth of my job was dealing with regulators. Y'all remember the SNL database? We had it, so I did a lot of free work for the regulators because we had the database, and my boss had no trouble volunteering my weekend time to work for the states. I used to eavesdrop on his phone calls, and I could hear him say, "Oh yeah, Ron, I'll do that for you." Okay, another weekend here, but after that, that was the rule, that was the law. States regulate, the NAIC will help keep that going, and that's still in place today. What happened after that is regulations just started getting bigger and bigger and bigger, especially in the early 1900s when you had Teddy Roosevelt, who was somewhat of a progressive president. A lot more regulations. That's when you saw a lot of food regulations and health regulations, but you also saw regulations on insurance companies and banks. So they had in New York what's called the Armstrong Committee, who suddenly got really concerned about how customers were being treated. It's called market conduct. How are you treating your customers? If they have a complaint about claims, how are they getting that resolved? And that created a whole new slew of regulations. Not every state, but it somewhat creeped into every state of market conduct. You definitely, if you go to NEIC's site, there will be a market conduct committee somewhere in here. Market conduct regulation, market conduct annual statements. It's a big part of what they do. If you have a major complaint about an insurance company, I've talked about this in my life insurance class, but you write a letter to the president of the insurance company. It becomes a presidential complaint. They've got to send it to an entire department that handles those. You can complain with the state. So if you really think an insurance company has ripped you off, and that's become a big issue on the property casualty side, especially on homeowners recently, where you're seeing State Farm, Allstate getting beat up for not paying homeowners claims. You do have some recourse. I would start with complaining to the insurance regulator and writing a presidential letter to the company. And they'll have to act, they'll have to respond to you. That doesn't mean you'll win, but you definitely will get, if it's a presidential complaint, you will definitely get some reference, some activity. So that was a law of land for 70 years or so. And then 1944 came along. Remember the 69 case was this person, Paul, suing a state. In 1944, a group of a trade association, the Southeastern Underwriters Associations, sued the United States. So it's not a person suing a state, it's an organization suing the federal government here. This is Southeast Underwriters Association suing the U.S. government. And what Southeast Underwriters did is they were a group of small insurers who got together and essentially compared notes on pricing. And the federal government says, no, that's antitrust. You can't do that. We have antitrust laws. Southeastern Underwriters said, yeah, but we're an insurance organization. We're not subject to federal law on antitrust. The U.S. government said, yes, you are. They took it to the Supreme Court. Southeastern is going back to the 1869 case and saying that states do have antitrust rules, but Southeastern want to avoid federal government. And the Supreme Court reversed that 1869 case, and they decided insurance is commerce. I gave you that court case. Let's see if that's link still working. Hopefully it is. Yep, there it is. Probably many more pages. I don't think it was a unanimous decision, and I think some of the Supreme Court justices said, you're right, it is commerce, but we've been doing this 70 years. We have this entire infrastructure set up. The states are doing a great job. There is no one in the federal government to do this. So there was some of just precedent. It's true, we're violating the Constitution, but what do they say? Let lying dogs lie or whatever. Just leave it alone. But Southeastern lost the case, and suddenly insurance companies are now regulated by the federal government, which is a big problem because there's no one to do it. You have all these state agencies regulating insurance companies. Now they're out of a job, and suddenly the federal government's got to do something. So Congress, and you should know this, when you go into an interview, McCarran-Ferguson Act, very, very important. I remember at the gym, I was on a bicycle watching President Obama talk about the Affordable Care Act, and he mentioned McCarran-Ferguson by name. So it's very well known. It's an act he did not like. He wanted to undo it. But the McCarran-Ferguson Act, what Congress said in 1945 is said, okay, Supreme Court's tied our hands. We're now responsible for regulated insurance companies. However, there's nothing in the Constitution that says that we can't, as the federal government, we can't outsource that work to another entity. We're responsible for it, but we can hire someone else to do it. So what we're going to do on insurance regulation is we're going to hire the states to do it for us. How will we pay them? We'll pay them by letting them keep those premium taxes they've been collecting. So problem solved, very, very quick. Solution. I don't know if McCarran and Ferguson were both Democrats or both Republicans or 101. I think probably one was one was the other. So pretty quick. You saw this come up in the healthcare debate. One of the things President Obama was really upset with the Affordable Care Act was the fact that health insurance companies were regulated by the states, not by the federal government. And so he felt, and there are people definitely questioning the antitrust of insurance conglomerates like United Health, CVS, Cigna. These are massive organizations that are probably doing more than they should be doing. They've been consolidating. And President Obama was like, we got some antitrust problems here, but I can't do anything because of the McCarran-Ferguson Act. And essentially what it said is it gave safe harbor to insurance companies saying you're exempt from federal antitrust and other federal regulations if you are in the business of insurance. Now, that business of insurance is pretty important. So, Microsoft hates antitrust. They really got beat up badly by the antitrust. Could Microsoft sell one auto insurance policy and suddenly get exemption? No, it'd have to be a major part of their business. They can't get around it that easily. And what you'll see with regulation, if insurance companies do nothing but insurance. So it's not like Microsoft could do 10% insurance. If they did that, they'd have to have an insurance subsidiary. That subsidiary would be exempt, but just that subsidiary. Microsoft itself would still be subject to federal government. So it's pretty strict. It's pretty clear. I can't think of any situation where a company is in the business of insurance that's also doing other things. It's clear cut. There's just not a mixture of that. USAA does insurance and banking, but they're completely separated, completely different entities, different regulators. So it's pretty clear who's insurance, who's not insurance. This is still in place, even though President Obama wanted it shut down. There was a time in my career, I think I'll talk about it up here, where it got challenged. So let's go through that. So this is where it hit me in 1989. We're having this banking crisis and a savings and loan crisis. President Reagan changed the tax laws, and suddenly real estate wasn't such a great investment after tax. And because of that, there was a real estate crash, and it caused banks and savings and loans companies to crash. And so this guy Dingle, he comes out and says, man, if banks are crashing, what about the insurance industry? And he looked at the insurance industry and he saw that their capital requirements were pathetic. You can have a massive insurance company with very, very little net worth. He said, my word, we're going to have an even bigger crisis with insurance companies. That's when the states got together, created the risk-based capital law, increased the capital requirements for insurance companies. But I remember back then we were writing letters to Congress. At that point, we were against taking McCarran-Ferguson down. We had lobbyists. You may not like lobbyists. I kind of like lobbyists. Our lobbyists at USAA, they understood. I mean, the things they were fighting for, I agree with, because if we had lost them, it would have been bad for our customers. So they're not just trying to make, they understand what you want. And I'm just talking to them, they picked up pretty quickly, and you might think these are sleazy people walking around passing out, $100 bills or something. It's actually, at least the part I saw it as a lot cleaner than that. These are people who have great knowledge of the industry, and they go sit down with Congress members and say, hey, here's what's going on. Yes, it's true the Congress member is going to listen to them because USA donates to these politicians, right? So there is that aspect of it, but they don't go in saying, hey, you do this or we're not going to donate. Essentially what they do is they say, hey, this is what we're concerned about. If you pass this law, this is what's going to happen. And that's what you want going on in Congress. You want them to hear both sides. So I thought it was fairly healthy. I'm sure there was a lot of especially on the pharmaceutical side and the healthcare side, there's probably some things going on that would be a little questionable. Um, so what happened? Um, Congress got distracted and they forgot all about it and nothing happened. It just dropped. We were like 90% chance Bingham was going to overturn McCarran-Ferguson, and then he got distracted, no longer interested, and just dropped, completely went away. And we were like, okay, what happened? The marketing, the FTC has tried to regulate insurance marketing because it's pretty deceptive, especially on the life insurance side, but they've never been able to win that argument. We talked about in my life insurance class how much I dislike equity-linked annuities and how bad the marketing is there. I can see a need for changing that. One place the federal government did win is on the life insurance side with variable products because they look more like investments than they look like insurance company products. And where they won there was actually the variable annuity life insurance company versus the US. The US won this one. And essentially what the federal government says is variable products are both regulated by the federal government and by the states. That means if you work for a life insurance company, you have to get two sets of license. You have to get insurance license and you have to get security licenses, which sounds horrible, but the nice thing is if you get them, you're worth a lot more money. You can get more jobs and you can move up faster. I talked about the health insurance reform. President Obama did not like McCarran-Ferguson, but he did not get it overturned. 2008 was probably helped secure McCarran-Ferguson because other than AIG, you did not see a major insurance company go under in 2008. And AIG did not go under because of insurance. It went under for a whole different reason. So the insurance industry essentially said, why are you picking on us? We're the good guys. We actually have our act together. Go watch out for those banks you were supposed to be monitoring. So that probably helped it. Is there an industry preference? Overwhelmingly, the industry preference is let's stay with the status quo. We know the states. We understand the states. Bob Davis at USAA was the one exception. He wanted the right to opt out for our federal charter because he hated the states. He hated having to deal with them, especially the tough ones like California, Hawaii, Georgia. But he was the lone wolf out there screaming for our federal charter. Most companies said if you go for a federal charter, the federal government's is going to regulate the stuff we don't want them to regulate. The states are going to keep regulating the stuff we don't want them to regulate. You're going to end up with the worst of both worlds. Where you like the states, that's going to go to the federal government and they're going to make it worse. Where you don't like the states, they're going to keep it. So it's not going to work. It's pretty interesting. The Insurance Council of Texas, they're the trade association for property and casualty insurance industry, and USA is a big member of that, and they had Bob Davis pushing this. So how did he handle that where most of their members said we don't like this? Eventually Bob Davis left USA, and I think Joe Robles just didn't really care about it and just went away. But you had one major CEO pushing for a federal charter, and it just didn't go anywhere. And I think at some point Davis even said, you'll get this done or your replacement will get this done. Hint, hint. This is pretty important to me, but didn't win that. Small insurers, they don't like federal regulators. Most of them like the state. A lot of them are in one state anyway, so they don't really care. They got one regulator. So yeah, this is what some people are worried about. The federal government is going to be really tough on regulating solvency, but the states will keep regulating pricing. It's just going to be this dual mess that you don't like. And the pricing is really the worst part of the regulation. So no McCarran-Ferguson. There's plenty out there. Probably on Google, or even you can probably find it chat GPT. It is interesting. I was mentoring a kid in high school. He went to Lanier High School. Really good kid, went to college. I need to get in contact with him. Really good kid. He gave a speech at the volunteer banquet at USAA. And oh my word, everybody in the room was crying. There was one lady behind me sobbing. He was so good. I was like, Chris, you need to be a politician. He knew how to pull the heartstrings. That kid was really good. So I need to see what he's doing now. But anyway, he had to write a paper. His teacher said it's extremely rare for the Supreme Court to reverse a prior decision. And I said, I got an idea for you that your teacher probably has never heard of. And that's this one right here. Southeastern Underwriter. So he wrote about that, and he was probably, I'm sure, the only student in the class that wrote about that. But it is a pretty rare example of the Supreme Court completely reversing, especially 75-year decision. Pretty rare. So it's famous in the industry. I gave you an article. I used to have a little bit of question on an exam on this, but I think we can probably go through it. It's an article on regulation and auto insurance premiums. The state regulation, states regulate pricing on insurance, and especially in certain states more than others. And so the article asks, is insurance regulation on pricing good for consumers or is it bad for consumers? And their answer is yes. Yes, it is. It's both. So does rate regulation help or hurt? They mentioned that rates are lower in regulated states, but in those states, insurers are not making very good returns, and so they leave the state, or they give really bad service, or they overcharge customers in other states. Rates aren't lower because they're overcharging. They were overcharging, now they're not. They're really undercharging, and they're just staying in the states because they want the homeowner side. So they asked the question, why is this the case? Why do we need regulation? So the states don't really regulate Pepsi Cola or going to Walmart. They don't regulate really banking anymore, right? Banks can pay almost any interest rate they want to. I know President Trump came out and said he's going to be a 10% cap on credit cards. I think that would be a disaster if he did that, because there's a lot of people who could never get credit then. But essentially, most of our lives is pretty unregulated. We know utilities are regulated because they're monopolies, national monopolies, so that kind of makes some sense. But why do states regulate pricing for auto insurance? You remember this, we talked about this earlier. What are the questions regulators ask about pricing? Is it excessive? Is it affordable? Are companies charging so much that their customers can't pay? Is it too low? If it's inadequate, companies are going to go insolvency. Is it overly discriminatory? Is it just not available? Companies have left the market. So those are the four things they look at. And regulators in some states focus really heavily on the excessive. They want to keep rates down. Why is that? Well, because a lot of states now have elected insurance commissioners. Texas doesn't. Texas insurance commissioner is appointed by the governor. But in states like California, the regulator is elected, and you're not going to run for a state office in California promising to increase auto insurance premiums. You're going to promise to decrease them. So they're focused on this. So what is the issue? So the first one you ask is there an antitrust, anti-competitive issue in Texas? So do you think Allstate and State Farm and USAA and Farmers are calling each other and artificially setting auto insurance premiums rates high? Does that feel right to you? Do y'all shop your auto insurance premiums? I recommend you do it at least every 3 years. It's pretty easy because there's like 5 companies you should go to and just take the cheapest one. I know every time, actually, I probably told y'all this earlier, every time actuaries get together in this industry from different companies, they start every meeting with, we will not talk pricing in this meeting. Every one meeting I ever saw. So we invited actuaries from the companies to talk certain issues or just compare notes, but we're not talking pricing at all, period. It's not a big deal because it's not that hard to get the pricing for other companies anyway. You can kind of do it yourself, so it's not like it's that difficult. Do y'all know the Herfindahl index? Have y'all used that in a class? Anybody? So I would know the Herfindahl index. It's real simple. First of all, and it would be really helpful in some of your papers. Let me show you how simple it is. You just take the market share. I don't actually do it like this, but you take the market share of every company. So let me see if I can do the insurance industry now. So let's say State Farm on auto insurance is say 20% of the industry. Allstate is say 10%. Progressive is say 7%. Geico 7%. USAA is 5%. Farmers is 5%. And then everybody else is really, really small, like 1% or so. What the Herfindahl index says is take their market share and square it. And you sum the squares. So everybody else is going to be really, really small. They might add up, 1% squared is 1. So the other companies, it's not going to add up to much. And you take the sum of that. And if it's over, say, 900 or 1,000, you have industry concentration. So if Allstate was, say, 60%, you'd have a big problem, right? If Allstate was 30%, you're somewhat uncompetitive. But Allstate's 20%. So I've done the Herfindahl index before. It's a little tough to get, but when I had the S&L database, I could bring in the auto insurance premiums for every company. I'd have to compare, bring all the Allstate companies together. I got numbers in the kind of 800, 900 area, so it was kind of high. But it wasn't over 1,000, so it wasn't bad. Any of y'all, if you're doing a project on banks, it's really amazing when the federal government looks at a bank, two banks merging, it's not looking at the US concentration. They're doing county by county by county. And they're doing Herfindahl index in each county. And there is an FDIC database online where you can actually get, if they do it by deposits. So Frost Bank in San Antonio, what percentage of bank deposits does Frost Bank have in San Antonio? That was what, if Frost is going to buy, say Frost, USA needs to sell off its bank, not to create any rumors, but they need to. That's their Achilles heel. What if USA said, we're going to sell our bank and say Frost is going to buy it? The federal government's going to look at that and see what percentage of deposits Frost has, USA has, add those together and see what that does to the Herfindahl index. So they might say, you know what, it's not a problem in San Antonio, it's not a problem in Dallas, but it is a problem in Houston. So in Houston, Frost, for you to buy this bank, you're going to have to shut down 20 of your banks or sell off 20 of your banks. It's really pretty amazing the detail they go into to assess this. So it's not at the national government level. They're actually calculating Herfindahl index at each market, not even state level. Every county they're calculating that. So when Exxon and Mobil merged together, Exxon had to sell off some of its stores because it had too high of a concentration, not in all over the country, but in certain specific spots. So it's a pretty amazing thing. But that's the Herfindahl index. It's really, really simple. Just take the market cap of each company, square it, add it up. If it's below $1,000, you're probably okay. And so what this article says is the Herfindahl index is probably okay at the national level, but if you go into a state like Hawaii, it's pretty concentrated. And you could make an argument in Hawaii there aren't enough insurance companies. Hawaii has an issue with banking. There's not enough banks in Hawaii. That's pretty concentrated there. So there's two big Hawaiian banks. They probably would never be able to emerge because they dominate that market. So I would know the Herfindahl index. It's one of those things that you hear a lot for industries that do mergers and acquisitions. So it's really good to know. The other thing is economies of scale. You could argue that Amazon is pretty concentrated, has too much power, but Amazon's going to say, yeah, but that means we're so much more efficient. We can pass that efficiency on in prices to our customers. You shouldn't be worried about too much concentration because our customers benefit from that. That's part of the argument that Geico and Progressive make is they're direct writers. They don't have commission agents, and they've really reduced the cost of insurance and the fact that they're picking up a big chunk of the business. They're probably higher than with the numbers I just showed you. They're the fastest growing insurance companies in the business, mainly because they're cheaper and they have an advantage cost wise. And so their argument for why they're picking up market share is you shouldn't be concerned about that concentration because the policyholder is benefiting from it. And so that's part of the argument you can make another side. Another issue people raise is why are auto insurance premiums rising so much? It's because insurance companies are just terrible managers of expenses. They're just really, really wasteful. I think you can make that argument when you're looking at USAA when its expense ratio got so high and State Farm's USAA is at 30%, State Farm at 28%, Allstate in the mid-20s. You could make that argument until Progressive and Geico came along with those 18 and 19% expense ratios and essentially kind of attacked the company into these other companies. I think USA's kind of back up into that level. I do not know their current CEO. He's the first one I've never met, so I'm kind of completely lost my connection with USAA. Y'all do know USA's CFO, right? Good UTSA grad, Brett Seabolt. Anybody know him? Really, really good guy. So he's a UTSA grad. So he's still around, young kid, like in his 40s, and sounds old to you, but to me, young kid. So USA, I think, has some struggles with this where they do tend to be a little bit heavy on the expense side. They do have an advantage that Geico and Progressive has is USA is a direct writer. They don't have commission sales agents. That does reduce your costs. That's a huge disadvantage for State Farm. So I think this argument, if that's really true, I think Geico and Progressive just says if that's the case, we're just gonna come in and keep picking up market share because they are really concentrated on keeping costs down. They do a lot more marketing, and so they do have a fairly significant marketing budget. Some people argue the reason auto insurance premiums are so high is insurance companies are just not really good at paying claims. They just pay everything. I know people who say this is the case. They have a really minor fender bender, and the company pays for it without even researching it and say, man, you should come. I had a friend had that happen and said, I can't believe they paid $2,000 for that claim. There was no damage to that car. I was surprised when I had a claim and I had my bike stolen and they paid $1,600. They didn't research it. They just sent it to me. And I didn't lie, don't get me arrested. Everything I told them was true, but they didn't research it at all. They just sent me a check for $1,600 and it's like, okay, fine. Thank you. So that's nice. At the time, in the 70s, there was a time where investment income was not part of pricing. That's all changed. Now investment income is, y'all saw it in your math problem, it's just central to the pricing. But there was a time where insurance companies did not have to talk about their investment incomes as part of their pricing equation. Then the 70s came along with high interest rates. The insurance companies were making so much money off of that float. The regulators came in and said, you've got to start incorporating that into your pricing. The other issue raised is it possible insurance companies are just making these really high returns. They're making excess returns. And that is, how do you define it? You use GAAP accounting, statutory accounting, or you look at market returns. Regulators like to look at statutory and say, look at these huge returns insurance companies are making. But if you look at the actual market returns of this industry, it's not all that good. The property casualty insurance industry is not a high returning segment of the stock market. So you cannot find any way to really argue this is an industry making excess returns. So it's a little bit, and at the time this article was done, it's pretty clear insurance companies are not making that much in return. There was a regulator in California who said insurers have an interest, but not a right to adequate returns. That to me sounds like a violation of the U.S. Constitution. everybody has a right to adequate returns or just get out of the business. And you should if you start a business and the government comes in and says, it's a grocery store, but you don't need all those profits. I mean, you have an interest in those profits, but no, cut your prices 40%. Your customers deserve it. Is that a business you want to get into? Doesn't sound like a good business to me. So it's like, yeah, become a charity. Treat your customers better. And insurance companies are, no, we're gonna make a profit. Um, Fairness to policyholders, that's an issue. Should city dwellers pay more than rural drivers? Yeah, they should because they have more accidents. Their cars are stolen more often. Um, so you're going to talk about this in the exam question on credit scores. If you don't allow that, people with good credit scores are just going to not buy the insurance, and premiums can go up and up and up, and it's going to spiral down. Um, how accurate is the pricing itself? Are insurance companies pricing the right kind of thing? Um, that I think actuaries have that down very, very well. I don't know if I trust actuaries to do the math. They're heavy users of AI and really good at statistics, which is their training. I've never met an actuary that I mean, was not a deep, deep, deep researcher. We'll see Mufaro on Monday, right? And I think you're going to be really impressed. He's a very impressive student from UTSA, really, really good student, but also doing very well at USAA. And it's a pretty cool job because you're doing this, 40, 50 hours a week. You got all day long. I remember at finance at USAA, you're sitting in 40, 50, 60 hours a week. You can work on one project for 2 or 3 weeks. I remember building models where I'm just spending my entire time building one model. It's really pretty fun. That's what actuaries are doing. They're spending a lot of time just getting it precise. So I don't think this is an industry that's just like, yeah, 25-year-old males, let's charge them 20% more than 30-year-old male. No, they got the data and they're parsing it backwards and forwards. And then you have to worry about the solvency side because if you don't let them charge the right premiums, they're going to go out of business, or they're just going to leave the business. So essentially, what did I say? Which of these have the best argument? One thing they really noticed with the spiraling, those states who really, really regulated premiums, they saw a lot of insurance companies leaving the state. In New Jersey, actually, they had a governor election, which is all decided based on auto insurance because the whole industry just collapsed. All the big insurers just said, we're not going to write insurance in this state anymore. It's just not worth it. So if you don't allow insurance companies to charge the right premium, they can take their toys and go home. Say, we give up, we're not going to do this anymore. So the solution for the article, this to me wasn't a strong because it didn't really tie to the rest of the article because they threw in tort reform where they hadn't talked about it at all and fraud reform. That to me kind of goes without saying. You're always going to make sure the system makes sense, that it's fair, there's not waste going on. So the article really didn't answer the question if regulation is really working or what the solution is. But most insurance companies are going to say, let us charge what we want to charge. And if it's not competitive, we'll go out of business. If we're overcharging, someone else is going to step in like Geico or Progressive. Just let us charge the premium we want to charge. I think the main argument why auto insurance is regulated where life insurance is not is that you're required to buy auto insurance, especially the liability side. And since it's required, insureds are like, well, we're getting charged too much and you're forcing me to buy this. Homeowners, kind of the same thing, because if you have a mortgage on your house, you're going to have to buy a mortgage and you're going to have to buy homeowners insurance. So it's probably the fact that it's required and you can't get out of it. But I don't think this industry would completely rip off its customers if you just let it charge when it wanted to charge, get rid of rate regulation. But I don't know, I could be wrong. I don't have that feeling on my industry, which is the investment industry. You should read my blog on the investment industry. I do think it rips off customers quite frequently. Last night we had in my security analysis class, Ryan Himmelberg was speaking. He's a UTSA alum doing really, really well as an investor. And one of the students asked him, what's the state of this industry?
There's way too many people in this industry. A lot of people trying to beat the stock market where most of them aren't adding any value at all, but they're charging a lot of fees. You said you didn't see this 10 years ago. It's just thousands of people doing all the exact same thing. A lot of costs, but nothing to show for it. I don't see that in the property casualty insurance business. I see it in the investment world where there's a lot of people getting paid a lot of money to do stuff that's of no value to society or to the economy. So I'm not always like, hands off government, because I've seen too many people get ripped off by the investment industry. I'm taking my car in Friday to get to a mechanic. I feel the same thing about mechanics. I'm at their mercy. I have no idea what they're saying. I don't know if I need that jig of a wig or whatever that thing is. How much is it? Oh, it's $1,000. I said, yeah, I don't think I need it. I don't know. Is my car going to stop running? I don't trust them, right? So I think the investment world does that to their customers. I don't feel that way with the property casualty industry. I feel comfortable buying from them. I think they're giving me a decent price, mainly because I saw the inside story at USAA. These are decent people doing their job, and you'll see it with me tomorrow. These aren't people out there. How can we rip off our customers? Whereas dealing with investment banks, it's like, how can we rip off our customers? It's a pretty common discussion at some of these entities. So, all right. So there's a regulatory side. If you interview with an insurance company, you better know McCarran Ferguson. Very, very important. One last thing I'll do really quickly is the legal aspects of insurance, because it's pretty unique. So since you don't take business law, there are a few things on the legal side you need to understand. And probably one thing that you may have never had that I think is really important is what is essential for a contract to be valid. Does anybody know the 4, maybe 5 requirements? Any guesses on that? Have y'all had that before?
Can't sign it under duress.
All right, so you have to have, yeah, I forget how I worded it, but yeah, you have to have a meeting of the minds. Can't have compulsion. We'll see how I worded it, but it's in there, different words. But yeah, that's one of them. What else do you need? So I would know these 4 things. I don't know if we can do a mnemonic for it. So you have to have a meeting of the minds. There has to be an offer and acceptance. How does this work for insurance? Where insurance, they have agents. So one of the things I think is really, really bad that you don't have business law is my business law. We probably had 2 or 3 chapters on agency and how agency works. Who can bind a company? Insurance companies have agents and they have brokers. And then there are general agents. So there's agents that are specific, like State Farm's agents can only do State Farm. There's other agents that are agents to multiple companies, and then there's brokers. So an agent can actually bind the company. They can actually commit the company to contracts. An agent that does multiple companies, they can also bind their multiple companies. A broker cannot. A broker is not an agent. They don't work for the insurance company. They work for the customer. So they can try to sell products, but then the company has to accept anything that they do. So if you're working with a State Farm agent, they're speaking for the company. And when they sign something, you've got offer and acceptance with that agent. But if it's a broker, you don't have insurance until the insurance company accepts it. So that's pretty important distinction. So with insurance, the offer and acceptance, you may want to ask, when do I have that offer and acceptance? It depends on the person you're talking to, whether or not they have the agency of the company. This is actually pretty critical. You'll see with agency law, there are times where courts will interpret someone as an agent when they're not an agent if the company that person's been representing has been accepting their stuff without any complaints. They can't suddenly say, you know what, we've been doing this for 5 years, but we don't like the last thing they did. The courts are going to say, well, you set it up that this person was representing you. You can't just change your mind. But there's, I found it really fascinating. I had some really good lawyers teaching my business law. So I found it really, really good. So yours was kind of legal capacities. So I think that's where I put yours. The second one is consideration. So if you have a contract with your neighbor and you sell your neighbor your Ferrari, your brand new Ferrari for 4 cents, the court's going to say, yeah, that's not consideration. That's obviously so inadequate. Your neighbor should have known you were joking. They can't say, yeah, sign that. Oh, yeah, I'll sign that 4 cents. Thinking, hey, I got your signature. And the courts are going to say, no, that's so obviously blatantly wrong. You can't do that. So you have to have consideration. Now, the court's not going to say, oh, you charged 75 bucks. You should have charged $77.32. They're going to look at it and see if it's kind of the sniff test. The question here is with insurance, you pay the premium, but what did you get from the insurance company? All you got from the insurance company was a promise. The promise to do something if something happened. Could you go back 10 years later and say, you know what? I've been paying them premiums from 10 years. They didn't give me anything. I got no consideration. No, you can't do that. The courts say that promise to do something is consideration and it is adequate consideration, even if you never file a claim. So that's not going to get you out of that. The next one, which is what Miles was talking about, legal capacity. You have to be legally capable of entering it, and duress would be one of those things that would not be legal capacity. So it can't be insane or intoxicated. The biggest one here is a minor. Your 15-year-old can't buy auto insurance. You have to buy it for them. They can't be contract to that. There may be an exception. The one exception is necessity. It is possible for a minor to be bound to a contract if it's a contract for necessity. So then you can ask, is auto insurance a necessity? I don't know if there's been any case law on that, but it's possible. I don't know if y'all have seen the Jim Carrey movie Liar. Is it Liar, Liar? It's a really good movie. So how did she get out of the prenup? She lied about her age, right? And she was actually a minor. So she got out of the prenup and she won. And that's, it's a pretty funny movie, but that's like the best scene at the end. And then the next one I think is probably the most important to the insurance industry is you can't do something that's contrary to public interest. So if you sign a contract with your neighbor to buy, I don't know, some illegal drug. I don't know any illegal drugs, but whatever, some illegal drug, LSD or whatever. I don't know my drugs very well. And they don't deliver it, and you've given them money, don't deliver it. You can't go to court and say, hey, I got to enforce this contract. The court's going to say, that's illegal. They can't enforce it. Some people argue insurance could be contrary to public interest. You're incurring people to kill someone, right? They got life insurance on them, and there have been people, in fact, there's a lot of people that have been murdered for life insurance. It's pretty common. That's one of the first things the police will ask is, oh, you bought a $250,000 policy on your spouse 2 weeks ago. Oh, they just kind of accidentally fell off the side of the cliff while you were hiking. That seems interesting. So is insurance so contrary to public interest that after 10 years of paying your insurance premium, you go, hey, you know what? They're encouraging me to burn my house down or whatever. This is not a valid contract. But the insurance industry says, no, we require insurable interest. That's part of this. We want to make sure the person that would rather the event not happen, even if they consider the insurance proceeds. So we talked about insurable interest earlier. So that's how they protect them. So those are the four things: offer and acceptance, consideration, legal capacity, and it has to be legal. And then the last one is not required, but for insurance it is. And that's the correct legal form. Insurance must be in writing by state law. You can't have an oral contract on insurance. You can have oral contracts. If you watch Judge Judy or some of the other places, yeah, oral contracts, but you have to have proof if you had the oral contract. Now it's text messages, right? Let's say, hey, I've got the 47 text messages, and the judge is going to try to figure out if there was an oral contract. But insurance, yeah, you're not going to call up to the insurance company and have an oral contract. It's going to be in writing. The state law requires it being the contract being in writing because the state mandates the language that you use. So that's not going to change. So I would remember these. This is pretty important. You're gonna be writing contracts in your career. I had to write so many contracts in my career. I should have a law degree. Because the lawyers don't know what you're doing. They don't have time to mess with it. My lawyers would say, hey, here's the boilerplate language. You write what you want. It's like, okay, whatever, I'll make stuff up. So I understand contracts. It's kind of critical. There are some other interesting things related to insurance that's real quickly. Insurance is a personal contract. It's really tied to you. It's not a contract you can just transfer to somebody else. So it's very personal. It's a unilateral contract. Only one party has to act. You're not required by the contract to pay the premium. If you don't want to pay the premium, you don't pay the premium. But the insurance company is legally bound to act. If you've paid the premium, they have to pay your claim. So you're not on the hook for anything. Now, if you stop paying the premium, that's bad, but they can't take you to court for not paying your premium. You just stop paying it and you're off the hook. Unlike your bank, if you stop paying your mortgage, they can take you to court. But on insurance, you don't have to pay the premium. It's not a contractual requirement. It's a conditional contract. So the insured doesn't have to act based on certain conditions. You didn't pay the premium, you didn't protect the property. It's an aleatory. Y'all know aleatory? You know that word? I knew it before I even with the insurance because there's aleatory music. I don't know if y'all heard of aleatory music. So John Cage is the most famous one for that. It looks pretty wild. But John Cage wrote aleatory, it's just by chance. So John Cage wrote a piece called 3 Minutes something. I forget what it is. Oh, no, it's 433. Have y'all heard of that piece? So this is one piece I can play perfectly on the piano. So the pianist walks out, sits on the piano bench, turns on a stopwatch, and sits there for 4 minutes and 33 minutes, and the music is whatever sound the audience makes. That's aleatory music. And I can play that piece flawlessly. So that's what it means. It's by chance, completely by chance. He made a lot of money off that piece, so smart guy. So there's a bit of a gambling aspect to it. You may pay premiums for 10 years and get zero back. You might pay premiums for 1 week and get $500,000 back. It's really by chance. And the courts are okay with that. Courts are going to say, well, yeah, well, wow, that person got a lot back. You didn't get any. So it's alien. There's a big chance here you might or might not win. It's a contract of adhesion. One party drafts it and really states mandate it. The other party accepts it. And because of that, because you don't have much, you can't go in there and negotiate the contract. You just accept it. If there's any ambiguous language, the courts are going to side on your side and not on the insurance company side. We saw that some with the mold issue in Texas. It's a contract utmost good faith. So don't lie to your insurance company. They're trusting you to tell them the truth. And then we talk about value and indemnity. Okay, I'm going to stop it there, but there's stuff when you interview for insurance companies, know these basic things are pretty important. All right, so Monday we have a speaker, no class on Wednesday, then your papers the next Monday, and then I'll do the exam review as a Zoom after your papers are done. All right. If you are graduating and you didn't hate my class or really dislike me, come get a picture with me sometime before now in graduation because I want to, when you become a billionaire, I want to prove to people that I knew you.